In Chapter 6, we look at variable versus absorption costing and segment analysis. We're going to look in this example at a company. First, we're going to do some variable versus absorption analysis. Then we'll look at segment analysis for the same company. And last, we'll look at a quick ethics question in the variable versus absorption costing. So we have this company, Diego Company, that has one product. It sells for $80 per unit and two geographical regions. We have information about their variable cost per unit and their fixed cost per year. Actually, just going to add sales price of $80 and units of 35,000 here. We'll add up our variable costs because we need that information for our break-even analysis. So first we're asked for the break-even point in units. Remember that the break-even point in units is total estimated fixed cost divided by our contribution margin. So let's figure out what our contribution margin is. $80 sales price minus variable selling and administration. Sales price minus the variable costs. So our contribution margin is $36. Our contribution margin ratio, which we'll need for the break-even point in sales dollars, this stuff is carryover from Chapter 5, is the contribution margin divided by the sales price, expressed as a percentage. So for our break-even point in units, we're going to take our total fixed costs. So we add together our two fixed costs and divide by contribution margin of $36. Our break-even point in units is 36,000 units. For the break-even point in sales dollars, we divide total fixed estimated costs by our contribution margin ratio. So we have total fixed cost, overhead, and selling and administration divided by our contribution margin ratio of 45%. Our break-even point in sales dollars is $2,880,000. Now we're going to look at the unit cost differences under variable costing and absorption costing. If you remember from the PowerPoint lecture, the difference between variable and absorption costing is how we treat fixed manufacturing overhead. In variable costing, overhead, the fixed manufacturing overhead is not included as part of the product cost. Under absorption costing, it is included as part of the product cost. Remember, absorption costing is the costing we use under US GAAP and IFRS rules. So we'll bring our information from our up here where we have our variable costs for direct materials, direct labor, and variable overhead. And then for fixed manufacturing overhead, we need to change this 800,000 to a per unit cost. So we had total fixed manufacturing overhead of 800,000, and that was to produce 40,000 units. So we'll take 800,000 divided by 40,000 units to get a fixed manufacturing overhead per unit amount of $20 per unit. So if we add up all of our costs under each method, we get a unit product cost of $40 under variable costing and $60 under absorption costing, with that only difference being the fixed manufacturing overhead cost. Our next question asks us to figure out the total contribution margin and net income or loss under variable costing. So we're going to use variable costing per unit. So our sales, we sold 35,000 units at a sales price of $80 per unit. So we take 35,000 times $80. Our variable cost of goods sold is our unit product cost, variable cost, times the number of units sold. And our variable selling and administrative costs is the $4 variable selling and administration amount times the number of units we sold. So $4 times 35,000. Our total variable costs, we add them together. And then our contribution margin is our sales minus total variable costs. Or 1,260,000. We then have our two fixed expenses, our fixed manufacturing overhead of 800,000 and our fixed selling and administrative costs of 496,000. Our total fixed costs, we add those together, is 1,296,000, giving us a net operating loss of 36,000. So that is our net income loss under variable costing. Now we're going to look at the difference under absorption costing. Remember, absorption costing is our normal costing. So this is going to look more like the income statement that you're used to instead of the contribution margin income statement. This is similar to the income statement we would submit for external reporting purposes. So we calculated our sales. That's exactly the same under both methods. What changes is how we treat our cost. So under variable, we're looking at cost behavior, and under absorption, we're looking for product cost versus period cost. So our cost of goods sold is our $60 cost per unit under absorption costing times our 35,000 units sold. Gross margin is sales minus cost of goods sold. And our selling and administrative expenses. So we have both our fixed selling and administration and our variable selling and admin. So our fixed plus the variable amount for selling and administrative expenses. Under absorption costing, we have net income of $64,000. Our next question asks us to explain the difference between absorption and variable costing results. So the difference between the two we add 64,000 plus 36,000. So we have a $100,000 difference in income. Where does that difference come from? We remember that the only difference between the two methods is the treatment of fixed manufacturing overhead. The other thing that we know is that we made 4,000 and sold 35,000. So we have 5,000 units left in finished goods inventory. If we take 5,000 times our $20 fixed manufacturing overhead amount per unit, That is $100,000. So that explains why we have a difference between variable and absorption net income is because the of the fixed overhead and how it is treated differently. Under absorption costing, that cost is attributed to our product costs in our inventory. Because we haven't sold those 5,000 units, those costs are still sitting in our finished goods inventory. Our next question, what would have been the company's variable costing net operating income if it had produced and sold 35,000 units? So under variable costing, our results are based on the units sold, and they don't change if we produce a different amount than we sell. So it would still have been negative 36,000. The results would still have been negative 36,000. The next question is, what would have been the company's absorption costing net operating income if it had produced and sold 35,000 units? If you remember from the PowerPoint, there is that summary that says if we produce and sell the exact same number of units, then absorption and variable costing result is exactly the same. So if we had produced and sold 35,000 units, then instead of this $64,000 income, we would have had a $36,000 loss because variable and absorption are exactly the same result if we produce and sell the same number of units. The changes only come from producing a different amount than we sell. If the company produces 5,000 fewer units than it sells in the second year of operations, will absorption net income be higher or lower than variable costing? This also goes back to the Chapter 6 lecture and that summary in the PowerPoint, that summary table. So if we produce and sell the exact same amount, net income is the same, or operating income is the same under both methods. If we produce more than we sell, absorption is higher. If we produce less than we sell, variable is higher. So in this last question, we're going to produce less units than we sell, which means that the variable costing income would be higher.